Hello, David Harper of Bionic Turtle, and a brief tutorial on the credit-linked note, which is a bond with an embedded credit feature. This is a privately placed note. To understand, start with the bond owner, who pays cash to purchase the bond. That bond then becomes the reference asset in the credit-linked note structure. Now let's assume the bond owner wants to transfer credit risk away to some counterparty, specifically default and credit deterioration risk. With the help of the underwriters symbolized here, the bond owner can do this. The underwriters will issue securities to the investors or the CLN buyers in exchange for their immediate purchase price or contribution of the initial purchase. So this goes to the bond owner, and this represents the key difference between the credit-linked note and the credit default swap. These buyers have paid for this bond up front, so we say this credit-linked note is funded, unlike the credit default swap, which was unfunded, and we'll see what that means in just a second. Now consider the going forward scenarios. Probably the most typical is that nothing happens to this underlying reference, this bond. There is no downgrade or default. That's symbolized by the blue line. All that happens is the bond owner is paying the above market rate. The bond owner is going to need to pay an above market rate because the credit risk has been transferred to the investors. Now if there's a downgrade symbolized by the orange line, then that rate is going to shift down to a lower rate. So this is why the bond owner has been protected from credit deterioration. This rate will shift to a lower rate if there is a downgrade. Finally, consider the worst case scenario. If the reference asset defaults, then the investors are only going to get the recovery. So par value on the bond minus any recovery. And so we can say the bond owner has transferred both default risk and credit deterioration to the investors. And in regard to the default risk, that is just like a credit default swap. Both the CLN and the credit default swap transfer default risk from the bond owner to the investors. Credit deterioration is transferred in the case of the credit-linked note because we see that rate will shift down if there's a downgrade. That may or may not be the case in the credit default swap. It depends on whether the credit default swap is marked to market. If it is marked to market, then the credit default swap also protects against credit deterioration, but that may or may not be a difference between the two. So if we consider the bond owner, the key things to remember about the bond owner is that it's funded unlike the credit default swap. By funded, we mean this bond owner incurs really no counterparty risk or counterparty exposure to the investors. That's because if we think about these scenarios here, what if there's a downgrade or what if there's a default? If there's a default, because the investors have already paid the cash up front, the matter of settling this default is just a matter of withholding principal and or interest payments that would have been made. So the bond owner doesn't really need to worry about being compensated. They just withhold payments. They don't really have the counterparty risk exposure to the buyers. Now if we think about the CLN buyer or the investor, obviously their motive is yield enhancement. They'd like this above market yield that they're going to get compensated for in exchange for taking on this default risk and credit deterioration risk. However, these buyers are the one who do have counterparty risk or counterparty exposure to the bond owner. Let's be careful about what that means. Consider if the reference asset is downgraded or default, or even if nothing happens to it. You can see in all scenarios the investor, the CLN buyer, is really dependent on the promise from the CLN issuer that they will receive these coupons and eventually principal. So the CLN buyer or the investor really has the counterparty risk. And further, Another factor for that CLN buyer is specifically the correlation between the default risk or counterparty risk of the bond owner and the reference asset. The greater the correlation between these two, the more risk these investors are taking on. That is to say, that means the more likely a downgrade or default on the underlying reference asset implies a greater likelihood of the more correlated default from the obligation by the bond owner. So correlation between the reference and the bond owner is also a key factor. So that's a brief overview of the credit linked note. This is David Harper of the Bionic Turtle. Thanks for your time.